Welcome to the Riskwiser Zone, the podcast where we dive into the world of stocks and finance to help you make informed decisions about your investments. I'm your host, Lewis, and I'm excited to share today's episode with you. We're starting off with a story that's been making waves in the financial markets. The U.S. Federal Reserve has been easing monetary policy, but is it having the desired effect on the labor market? According to some experts, the answer is unclear. With the unemployment rate still at a historically low 4.3%, it's uncertain whether further rate cuts will encourage businesses to hire more workers. As we reported earlier, the Fed has shifted its focus towards the employment side of its dual mandate, but it's not clear how fragile the labor market really is. Much of the recent spike in jobless claims can be attributed to one-off weather events and the Trump administration's immigration and deportation policies. This has led some economists to argue that the labor market is more resilient than initially thought. On the other hand, others point out that the wealth effect seems to be prevalent, with Wall Street's big three indices, the Russell 2000 Small Cap Index, the tech sector, semiconductor stocks, gold, and Bitcoin all at record highs. This has led some to question whether the Fed should be factoring financial market conditions into their decision-making more than they have in the past. As always, we want to provide a balanced view of the situation. BlackRock economists argue that the current easing is typically associated with a much starker weakening of the labor market, inflation, and growth, none of which looks certain or even likely at this juncture. Their base case scenario is that resilient household incomes will spur a revival in consumer spending, and the wave of AI-related investment in tech equipment, software, and data centers will power growth. So, what does this mean for investors? Should you be optimistic about the future of the labor market, or are there warning signs on the horizon? We'll continue to explore these questions and more as we dive deeper into the world of stocks and finance. We'll be right back with more from the world of stocks and finance on the Riskwiser Zone. Welcome back to the Riskwiser Zone. We're glad you're still with us as we dive into the latest news and trends that could impact your investments and financial decisions. Today, we're focusing on a fascinating development in the world of finance, an everything rally that's sweeping across global markets. It appears that investors are embracing this rally, with nearly all asset classes experiencing upward momentum. From Bitcoin and gold to global equities, everything seems to be going up. But what's driving this trend? According to some experts, it's the prospect of global peace and central banks preparing for rate cuts. The idea is that as rates go down, assets will inflate, leading to a surge in prices. Now, we know that past performance is not necessarily indicative of future results, but it's hard to ignore the optimism among investors right now. Some are even suggesting that this could be a good time to stay the course and ride out the wave, with domestic liquidity remaining strong and returns from the market potentially settling around 10% or even 12% with some effort. However, as always, we need to approach these developments with caution and consider multiple perspectives. Not everyone is convinced that this rally will last, and some are warning about the risks of speculation and overvaluation. When it comes to alternative assets like gold and Bitcoin, opinions are particularly divided, with some seeing them as valuable hedges against uncertainty and others viewing them as highly volatile and unpredictable. As we navigate these complex and ever-changing markets, it's essential to stay informed, do our research, and make decisions based on a careful analysis of the facts. At the Riskwiser Zone, we're committed to providing you with balanced and unbiased information to help you make the best choices for your financial future. So, what does this mean for you? Should you be joining the rally or taking a more cautious approach? The answer will depend on your individual circumstances, risk tolerance, and investment goals. As always, it's crucial to consult with a financial advisor and do your own due diligence before making any major decisions. Stay tuned for our final story of the day, right here on the Riskwiser Zone. Welcome back to the Riskwiser Zone, We're wrapping up today's show with a look at some of the latest market news. If you've been following the IPO scene, you'll know that Tata Capital's massive 15,512 crore initial public offering has been making headlines. The issue was subscribed 1.95 times on its final day, which is a pretty strong showing. Meanwhile, LG Electronics, India's 11,607 crore IPO, was subscribed 3.32 times on its second day, with the qualified institutional buyers portion seeing a subscription of 2.59 times. Now, it's worth noting that the grey market premium for LG Electronics India shares has fallen slightly to 1298, or 261%, over the upper price band of 1,140. This could be an indication that investors are taking a more cautious approach, but it's still early days and we'll need to see how things play out. On the other hand, Tata Capital's grey market premium has risen marginally to 7, or 2.1%, over the upper end of its price band of 5,326. This could be a sign that investors are feeling more optimistic about the company's prospects. As always, it's essential to approach these developments with a critical eye and do your own research before making any investment decisions. Remember that the market can be unpredictable, and it's crucial to prioritize caution and diversification in your investment strategy. That's all for today's Riskwiser Zone. Remember to like, share, and subscribe, and until next time, invest with caution.